Welcome to the Crypto Prism channel. Let's take a look at Bitcoin's latest market structure. Let's first look at the 1-hour time frame for Bitcoin. After a one-sided decline from the 98,069 high, price dropped to a low around 59,896, printing a long lower wick bottoming candle, confirming strong demand in that area. It then staged a sharp V-shaped rebound. The current price is 68,916, holding above the Fibonacci 0.236 support level at 68,905. Structurally, the 1-hour time frame is still within a downtrend framework. The rebound is an oversold recovery, not a reversal. The 71,800 level above is the core supply resistance zone, where trapped positions and selling pressure are concentrated. The MACD histogram is contracting, rebound momentum is gradually weakening, and volume follow-through is insufficient. In the short term, price is likely to consolidate within the 68,900 to 71,800 range, digesting and building energy through pullbacks. From an execution perspective, the 1-hour time frame should focus on key level confirmation. Only a firm hold above 71,800 allows for continuation of the rebound. If rejected and pulled back, it returns to weak consolidation. Strictly rely on swing highs and lows for risk control, and avoid getting repeatedly stopped out in choppy conditions. Now switching to the 4-hour time frame, the overall midterm structure becomes clearer. After initiating a downward swing from the 126,477 high, price has consistently followed the gray descending trendline shown on the chart. Every rebound has been precisely capped by the trendline. The broader midterm downtrend structure has not shown any substantive reversal signal so far. During this accelerated decline, price wicked down to 60,030, perfectly resonating with the 59,800 core support level we previously identified. This candle printed a signature ultra-long lower wick, a very typical bottom probing pattern. From a capital flow perspective, after price smashed into that area, panic selling was fully released, while off-exchange demand, bottom-fishing buyers, and short-covering capital entered simultaneously, instantly pulling price back from the lows. In essence, the downside was strongly rejected. The 60,000 level showed real capital support and the market clearly refused lower prices. Looking at volume, the 4-hour bottoming phase printed a stage of expanding volume, proving that this stabilization was not a low-volume fake pump, but involved real capital rotation and effective absorption. However, we must clearly distinguish this. A long lower wick only represents short-term selling, exhaustion, and rejection of new lows. It does not equate to a direct reversal of the downtrend dot from the Fibonacci retracement perspective. For this decline from 126,477 to 60,030, the 0.236 key rebound resistance is at 75,711. Meanwhile, the previously emphasized 71,800 core supply resistance sits exactly at the first critical bottleneck of the 4-hour rebound. This area is both a dense trapped position zone after the breakdown, and a defensive zone for bears within the descending channel. Trapped longs, break-even sellers, and trend shorts all concentrate selling pressure here. The current price is trading around 67,800 in a rebound repair phase following the low-level support. However, the 4-hour time frame is still suppressed within the larger descending channel. Rebound momentum has not formed a sustained volume breakout pattern. Before reclaiming and holding above key resistance, this remains an oversold rebound within a downtrend, not a trend reversal. On the 4-hour time frame, focus on two key levels. First, 60,030 to 66,000 below is the core defensive support zone. As long as pullbacks do not break the low or engulf the lower wick body, the bottoming repair expectation remains intact. Second, 71,800 above is the strength-weakness dividing line for the 4-hour rebound. Next is the Fibonacci 0.236 at 75,711. Only a volume breakout and firm hold above resistance can upgrade short-term sentiment repair into mid-term structural repair. If price continues to be suppressed below 71,800 with declining volume, the market will likely enter a sideways consolidation phase, with repeated pullbacks for digestion. Avoid letting choppy price action repeatedly consume your position before the trend truly reverses. Now let's look at the daily time frame for Bitcoin. On the higher time frame, price has declined one-sided from the 126,477 high along the descending trend line. The midterm downtrend has not reversed. Price bottomed at 60,030, printing a high-volume, long lower wick bullish candle, forming a piercing pattern with the previous bearish candle. A standard late-stage downtrend stabilization signal. The 60,000 level showed strong capital support. Panic selling was concentrated and cleared, and the market clearly rejected new lows. From a volume perspective, the bottoming phase showed expanded volume turnover, confirming an effective absorption. However, stabilization is not reversal. A long lower wick only represents short-term selling exhaustion and cannot reverse the higher timeframe downtrend structure. In terms of key zones, the first daily resistance is 71,800, a dense trapped position and supply area. Secondary resistance is the Fibonacci 0.236 level at 75,711. Core support is 60,030, with short-term defense at 66,000 to 68,000. Future price path assessment. If the daily chart breaks and firmly holds above 71,800 with expanding volume and continues higher, the rebound upgrades into structural repair. If price remains suppressed below 71,800 with declining volume and breaks below the 68,000 defensive level, the rebound is merely technical repair and price will return to choppy pullbacks, retesting lower support levels. Operationally, use daily key level breakouts and firm hold as right side confirmation signals. That's it for today's video. See you tomorrow.